Hi, I'm Jim Jubak, and welcome to my YouTube video for today, July 27th. If you like this video, please like it. Please subscribe to this YouTube channel. That'll give you that notice. If you would like to read more of my stuff, you can go to my free site. That's jubakpicks.com. We're 3 portfolios, including the dividend portfolio. Or you can go to my paid site, which has 6 portfolios, and that includes some options and hedges, and I'm doing a lot of sort of hedging about the coming recession on that site. The title for today's video is Investing to Beat the Coming Recession. No, this is not another one of those things about where to put your money and save. I've done one of those. In fact, you can find it where to stash your cash at jubakpicks.com/stash your cash. Here's how I'm thinking about this topic right now. I'm thinking of the market as sort of being like an onion with the recession peeling away layer after layer. So a great example of that was in the last week with Snap and Alphabet, the company that's formerly known as Google. So let me look at the 2 charts. This horror show is Snap on the day after it reported that it had seen advertising revenues go down the tubes, and it fell 39% on the day. This is the day after earnings. Earnings after hours, next day, 39%. Okay, my next chart is Google, which also announced earnings, and you see it actually climbed. And they didn't climb because they announced something really, really great. They basically climbed because they said, hey, unlike Snapchat, we didn't see advertising revenues drop. In fact, we came in a little above Wall Street estimates. So hey, what it looks like if you're an outside investor is that companies buying online advertising are going with companies like Alphabet, Google, and if they're trying to stretch their ad dollars, they're putting them there as opposed to companies like Snapchat. So logically, if you're an investor worried about a slowing economy, you should be looking for the Alphabet Googles of any particular market and avoiding the Snapchats. So you look at companies that are relatively stronger, relatively bigger, etc., and that's where your money should be going right now. The problem with that is that as you peel away layers of the onion, or as the recession peels away layers of the onion, and remember, we're not officially in a recession yet, the definition of the safe Alphabet Googles of the world gets narrower and narrower. And we got an example of that this week in Walmart. Walmart, which had been seen as a big beneficiary of inflation and tighter wages and all that, because more people would go shopping looking for discounts, announced that they lowered their guidance for the rest of 2022, the second time this year, and basically the stock dropped. Not a Snapchat kind of drop, but 10% on the day. You know, Walmart was seen as a safe alternative to the Targets because it had a bigger grocery business, etc., etc. But now we're seeing a reevaluation of that and going, hey, well, yes, they do indeed have a bigger grocery business, but groceries have a tighter margin than many of the other lines. And what we're seeing is people stop buying apparel or hard goods and shifting their money into groceries because they've got to, and that means lower margins for a company like Walmart. And what this is an example of is the problem that as the recession gets closer and closer, I think that you're going to continue to see a shrinkage of the companies that are thought to be able to grow through, around, or in spite of the recession. And each time we get a reevaluation of that, we get a Walmart situation where the stock drops 10%. So right now, people are saying, hey, look, Chipotle's got pricing power. Maybe I want to buy CMG. Or Coke, which has been able to use packaging, among other things, to fight inflation. So maybe I want to buy Coke. I think the problem with all these things is that, yeah, that's business as usual with a little twist. And I think the little twist is not going to work in this market. I think you need to think beyond the next couple of weeks as you think about recessions. And my suggestion is that you look at utility stocks. If you don't want to do individual utility stocks, you can buy an ETF. XLU is the Spider utility ETF. Or the other one that's doing really well is healthcare. and there's indeed an ETF for that, XLV, again, the spider utility. So that's my suggestion for right now for trying to get ahead of the recession curve. If you like this video, please like it. Subscribe to my YouTube channel. You can get more of my stuff on jubakpicks.com. That's my free site, or 6 portfolios, including a lot of hedging and some options on my paid site, and that's jubakam.com. Thanks very much for watching.